Hey guys, this is Prashant Kumar from Cashflow Champs. We are helping investors gain financial freedom through passive investments in real estate. Thank you so much for joining today. This is an honor that you guys are spending your time learning what we have to say. Today's topic is right debt structure in multifamily. This is a vast topic, and by no means I'm an expert, but I will try to impart as much knowledge as I can. And feel free to ask questions in Q&A box. The chat may be disabled, but feel free to ask questions in Q&A box and I will try to answer. Most of these answers are our personal experiences, so hopefully we are able to create some value for you. Once again, as a disclaimer, I'm not an attorney or a financial advisor or a tax advisor or an accountant. The purpose of this webinar is for informational purposes only. You should seek professional advice from appropriate personnel. Just a little bit about myself. I am married, of course, 2 kids. I live in Long Island. I'm managing partner in Cashflow Champs. I've been a consultant in IT in multinationals over 25 years. Our team portfolio at Cashflow Champs is 146 million assets under management with about 1,650 doors. I'm a co-host of Cashflow Champs Real Estate podcast along with my partner, Paul Sr. I've had about 2,000 units in past. On my personal portfolio, about 1,000 units currently. We sold some of them. My passions are, I love helping others. I love multifamily space and assisted living space. And I meditate regularly. I spend a lot of time meditating and helping others to meditate also, free of cost. That's sort of my why in this life. So before we begin, there are multiple ways folks can connect with us. You can schedule a call with us directly. There are 3 QR codes here on the screen. You can schedule a call with us. We have free underwriting sessions that we run every Saturday at 4 p.m. Eastern. Those are free. They have been free ever since the dawn of time. I mustn't for last 3-4 years. So feel free to scan that, register for that. You want to talk to us one-on-one, schedule a call with us, the leftmost QR code. And in addition to that, obviously we have an inner circle group where we prepare everybody else to participate actively in multifamily investing. We are calling it coaching, but it's really an inner circle. We meet twice a week. We help, we mentor, and we guarantee that you will get into a deal within 1 year as a general partner, or we will continue to coach you, mentor you for as long as it takes. So feel free to check us out. Okay. Today's topic is actually a vast topic. I will try to discuss whatever I can discuss, but it will depend on what questions you have, because obviously time is limited and we can discuss only what is most important for you. So basically, best sources of debt, we are going to learn about best sources of debt for multifamily investors. How do you evaluate your options, negotiate your debt terms, and you maintain ongoing relationship with lenders and brokers. This is a very fluid environment. Over the last 1 year, at least in the last 1 year, things have been very fluid. A lot of changes on the agency side and stuff like that. So maintaining ongoing relationship with these brokers and lenders come handy, and much more, basically. So let's start, okay? So what are the sources of debt in multifamily? If you are a small, first of all, it's, U.S. government agency loans. We have FHA loan, Freddie loan, Fannie loan. Most of you must know about them, but FHA loan is available for us, but it is only up to 4 units. And it is considered basically sort of a property valuation, not property valuation, property income. So banks look at FHA loan, they look at 3 out of 4 units, the rents received from 3 out of 4 units. They don't look at DTI like residential loan. So it is possible to take a FHA loan on a 4-unit or duplex. Of course, on single family also it is possible. But those who move on beyond 4, you go to Freddie and Fannie, right? These are agency loans. Most of you must know it. And there are subtle differences between Freddie and Fannie. If we discuss that itself will take an hour. But, you can, Freddie and Fannie, anything above 4 units, anybody can go. They have Freddie small business loan or Fannie small business loan are available. When I say small business, small loans, basically up to $2 million, those kind of loans are available. Or if the loans are bigger, obviously Freddie and Fannie are the best loans. But the problem with them, your occupancy has to be more than 85%, I think, and the DSCR has to be 1.25. So U.S. government agency loans are available for cash flowing assets, where your occupancy is more than 85% and your debt service coverage ratio is greater than 1.25 at least, because obviously banks wants to make sure that all the income coming from property is able to take care of the debt service. So these are most popular loans, but they are available for cash flowing assets. Up to 4 units, you can go to FHA. After that, you have small Freddie SBL, Fannie SBL, and then Freddie and Fannie regular loans. Besides these, you have CMBS, commercial mortgage-backed security loans. These are fixed loans, term length, but have higher prepayment penalty, and these are again for very stable. CMBS is more of very stable kind of asset which you plan to hold for long term, because they really discourage you to, if you want to switch lenders, they have higher prepayment penalties. So these are primarily for Freddie and Fannie, then CMBS. People go, syndicators like us go into Freddie and Fannie because we are typically 4 or 5 year hold kind of investors, right? So we buy an asset, we upgrade it, whichever way, whether by improving the asset class or repositioning the tenant or bringing the efficiency, we improve the NOI. And, once the property is stabilized, after a couple of years, we move on. So that's why we get into Freddie and Fannie loans, as long as, they are at the time of, as long as DSCR is greater than 1.25, typically 1.3 or 1.35 is better, but at least 1.25, and the occupancy is greater than 85% at the time of loan origination. When we get into a property, there are options for bridge lenders also, right? Bridge lenders are typically, IO kind of interest only kind of terms where you get maybe 24 months of interest only payments. They are primarily used for where you want to increase the valuation by putting a lot of capex into the property. and where you are not qualified for Freddie and Fannie or CMBS. So Freddie, Fannie, CMBS, if you're not qualified for them, you go into the bridge lenders because you have higher capital expenditure that you want to do onto the property. Sometimes the and bridge lenders, they try to give you 100% of capex because obviously they are making money. They have higher interest rate. They are mostly recourse, but sometimes they are non-recourse also. Freddie and Fannie are non-recourse. CMBS is also non-recourse, but bridge lending is mostly recourse. Then after that, you go into local banks. In the last 1 year or so, we have seen a lot of properties which were not qualified for Freddie, Fannie, or CMBS, and bridge lenders were giving hard time. They were sitting on the sideline. They were not willing to, fund the projects. In last year, we have seen a lot of local banks and credit unions coming up and offering loans. I have seen at least 3-4 loans myself with my friends' loans who otherwise would have gone into Freddie and Fannie, because Freddie and Fannie reduced their LTV. They were giving up to 65% LTV or less. I mean, I've seen even 55 LTV in last year or so. And that's why those deals did not make sense. Folks ended up going to either to bridge lenders or to local banks or credit unions, where they were able to get up to 75% LTV or 80% LTV in some cases. And those are very stable kind of loans. Short-term loans could be 3 years, but long-term loan could be 10 years. However, they are recourse. So banks could come after your personal assets if you mess up on the deal, and basically if you are not able to pay off that loan. So these local banks and credit unions, even though they are small, but they don't go beyond certain dollar value. I've not seen any local bank giving a loan more than 10 or 15 million. The most credit unions and local banks would be comfortable to give loans up to 5 million. So that's an option if you have an asset where you need only 5 to 7 million or maybe less than $10 million, then local banks and credit unions come very, very handy. And of course, after these banks, then you have private money or hard money loans that you can get. Again, they come with very high upfront cost. You may have bad credit. The area is not good. You have high vacancy, very high vacancy, and you have a realistic exit strategy. I mean, you can get the loan from hard money lenders. Actually, hard money lenders is not a good loan if you are going into multifamily. You can get some private money. Again, they are a little bit more costly. And I'll talk a little bit more about hard money and private money in subsequent slide. But we do not look at those loans in our strategy. We only look for Freddie, Fannie, CMBS, bridge lenders, or local banks. The best way to find these loans is connect with more brokers and connect with established brokers who have good relationships with these banks. So private money, hard money, and then you have promissory note. I mean, notes, basically, if you know somebody, you can write promissory note with them, or you can write promissory note with the seller as well. After that, we have SBA loans. SBA loans are primarily for business loans. They are a little bit difficult to obtain because obviously banks wants to make sure that you would be able to take care of their debt service. So they look at your global cash flow, and they look at your liquidity. They look at what is your realistic business plan, and whether in a year or so would you be able to pay the loans. So the most important thing for the bank is whether the business that you are trying to open would be able to support the debt service, and whether the valuation of that business would go up to a level where if you really have to sell, whether you can pay off the loan or not. So SBA, basically government loan, and similarly USDA loans are available. I have SBA loans, I've done SBA loans, and we have done USDA loans also. Very, very difficult to obtain. USDA typically goes into rural areas where they have certain criteria that population is not too much, and obviously there are growth patterns for that area. So have we done USDA loans? I personally have done one USDA loan. It took me more than 5 months. And it depends on the grant, if the grants are available or not. So that is something, if anybody needs more information on SBA or USDA, depending upon kind of property you are looking at. If it is multifamily, I would suggest that we stick to Freddie, Fannie, CMBS, or bridge lenders. But if you want to go into a slightly different business model, then SBA, USDA may be of some importance to you. After that, you have construction loans. These construction loans are primarily through bridge lenders or through local banks, and part of it could be through USD or SBA loan. That's not a separate bullet in itself, but in your SBA and USDA loan, you could include construction loan also. After that, you have seller financing. If seller is willing to do a promissory note or do a pref equity after your Freddie or Fannie loan, that would be the best option. Hopefully seller is little considerate in terms of their terms. Can you buy the whole property on seller financing? Yes, there are a lot of people. That's a strategy that people use, and typically below 50 units. You can buy the whole building. Seller may say that, I want 75%, you bring 25%. And the reason seller financing is popular because seller wants to, prorate their income over a couple of years. They don't want to have all the capital gains in 1 year one. So they do the seller financing, and that way, because they get certain portion of capital, they kind of divide their capital gains over the period of the loan that they give on the property. So seller financing is very popular. If you can find a property with seller financing with little down, that would be the best thing. But in bigger properties, 100 plus units where we have more professional syndicators, it is kind of difficult to do seller financing. So just wanted to communicate that. And after that, you have master lease. You can have an equitable title. You get the mortgage from the seller, and the buyer has the option to buy the property at a predefined value at a later time. So master lease is also a very attractive option. After a couple of years, you have the option to buy the property at a predefined value. So a lot of people in lower unit count range, when I say lower unit count range is say 50 units, 50 to 70 units, up to 70 units, I would say. I've not seen master leases myself, and maybe I don't know about bigger scale, but master leases typically are in lower unit counts up to say 50, 60, 20, 30, 40, 60 in that range. So once again, to recap on this slide, a lot of information on this slide, but you have FHA loans, you have Freddie, Fannie, CMBS, bridge lenders, local banks, credit unions, private or hard money, SBA loans, USDA loans, and master leases, seller financing. important thing is we should have connection with right brokers. That is the most important piece. You cannot go to all these lenders yourself. It's just not a wise use of your time unless you have established a relationship like that. So it is very important that it's very important that you have good relationship with your lenders. So Casey is asking, if fourplex DSCR is 1.45, is that good one for bank or credit union? Also, what would be expected down for loan? So if the DSCR is 1.45, I think that would be a good option, basically, Casey. And the down payment for that would be, I must say, you must be able to get a 75% loan easily. It may go up to 80% also if your DSCR is that much. So let's talk. What is the process with these banks, Freddie, Fannie, or whomsoever you are talking? Number one, you are talking to your brokers, and these brokers are connecting with these banks. Sometimes you are connecting yourself with these banks also. But before banks start the work, initial call with them is to tell them about your deal. After that, if bank will at a very high level say yes, they want to proceed, they don't want to proceed. Bank needs some deposit, right? So you have to have some capital that some capital that you need to shell out before banks start looking at your file deeply, right? So they would ask for some deposit, maybe a couple of $1,000 depending upon the property valuation. You'll have to provide all your financial T12, last 12 months of financials of the property, which you will get from the seller. You will get rent roll, and you will give them the OM. So banks, then these guys will do the underwriting, right? And they underwrite financial underwriting of the borrower. So they underwrite the property, making sure property is making money, and then they want to underwrite the borrower. The borrower is not, bankrupt, and they have good financial standing, right? Once the property and the borrower underwriting is done, then at that time, banks start spending money. Typically they would go back to the loan committee and make sure that yes, they are interested. They will start spending money. They will order an appraisal and inspection, right? And they may order environmental, termite, title. So all that they would start. But again, that will cost money. Obviously, funds are needed. Sometimes, bank do that expenditure themselves from the money that you have already sent them. Sometimes it could be that they have the deposit, just they took only small deposit from you, and they want you to pay for appraisal, inspection, environmental, and title and termite, those things. So and then it goes on. They do more underwriting, more documents, and then finally, once the package is put together, everything is checked out. Appraisal is good, inspection is good, environmental is good, termite is good, title is good. At that time, the final file goes to the loan committee for approval. And once it is approved in the loan committee, the closing date is scheduled. Then the responsibility on borrower side is to make sure that borrower is aligned in terms of the equity. Equity has been aligned, and borrower is in good shape to be able to bring the equity to the table at the time of closing. So I just wanted to kind of discuss what the process of closing these bigger deals, whether it's big or small. Typically, this is the process, So what are your options? As I said, if you are in Freddie and Fannie, there the property has to be occupied 85%. Your DSCR, again, it is typo, it's 1.25, not 12.25. Sorry about that. And if the occupancy is below 85 and you are not, property is not currently properly doesn't have 1.25 DSCR, then it's more of a bridge lending option. And in some cases, it could be a local bank or a credit union option also. There are certain banks, local banks and credit unions, who will go and give you a loan on the property valuation, and they will give you a construction loan also on top of it. So bridge lending and or commercial and local bank or credit union, they can help you for the properties which do not have 1.25 DSCR and 85% occupancy. Those are your best bets, and they obviously look at what is the upside, what is the area. Local banks and credit unions are very intimate with the area, and they know what's going on in the area. So they are better sources of equity for debt, basically, for those those kind of projects. And of course, sponsor experience is very valuable. I mean, they always check, whom they are giving the money, right? I mean, it's not like it's available for anybody. If you already have done project in that area, they just want to feel comfortable that you would be able to execute your business plan. So sponsor experience is very important. So as I said earlier, we have the debt environment has been changing constantly over the last 1 year, right? So for you to get the best possible loan terms, one must continue to talk to these lenders and equity and debt brokers, because these debt brokers are able to find the right kind of loan for you. Lenders can offer only what they can offer, but these brokers can get out and give you more information, and they can widen your search. So it is very important that we continue to communicate with them. I mean, we have access to many lenders, we have access to many brokers. Obviously, you can find brokers online, and they're willing to talk to you because obviously they make money. But in Freddie and Fannie, there are many lenders, Arbor, CBRE. You can directly reach out to them. There are many, Hunt, and then you go to CMBS. CMBS is a different untapped area. Not untapped, I would say it's a little difficult. Anybody needs an introduction to anybody, we can do that definitely. And we meet lenders and brokers on a regular basis. We talk to them. We spend a lot of time. We are aware of what is changing in agency. When is agency changing their debt terms? There was a time when agencies started giving 35-year amortized loans last year. I'm not sure whether that is happening right now or not, but those details are important because those things matter in our underwriting. Their LTV went down from 80 to 55. Is it going up? I have seen that going up also. So there are always changes in what agency is offering. So we have to be up to the speed. If we are in this business, we have to be up to the speed to the fact what is happening in the debt market. Again, it's a vast topic. We cannot cover the whole thing here. Let's see, what do we have? So I wanted to talk about hard money or private money. Okay, there are a lot of people who are out there who are pretending to be hard money lenders or private money lenders. In commercial world, there's nothing called 100% financing. That just doesn't happen. Okay, if your terms are too good to be true, if somebody is offering you private money at 5, 6, 7%, that's too good to be true. And I'm telling you with experience, Those who don't disclose the source of money, where's the money coming from, probably they don't have that information. So make sure that you are not getting caught up with those folks. These people ask for higher upfront fees before starting to work on any loan or equity. I would say just run. And I will give you real life examples. I have many examples where these people take money from you for loan or equity, and they just run away with that money. And they put some clauses wherever, and you cannot sue them and stuff like that. So all in all, I would say hard money or private money, try to avoid. It's not worth your time and attention. I'm saying it with my experience, first-hand experience. Do not get involved into private money or hard money for multifamily projects. Smaller projects, residential projects, if you are doing it, continue to do that. But bigger projects, you will end up losing your shirts. All right. So again, as I said, connect with us. Let me take some questions. So for loan, Tui is asking, can you talk about loan assumptions and what are the needs for watch out? So for loan assumption, so basically in loan assumption, important thing is that whether, so it really depends on the lender, okay, for the loan assumptions. We have heard a lot of horror stories on loan assumptions, and I'm not trying to scare you, but in loan assumptions, obviously, property is underwritten at the time of sale. Borrowers are underwritten that their net worth is more than the loan amount, and they have liquidity, and that service coverage ratio on the property is still more than 1.25, and liquidity, net worth, and cash flow, basically global cash flow is on the property is still in line. So that is important. And then if you are assuming a Freddie or Fannie loan, is the borrower, is the guarantor on the loan, have they done any loans with Freddie and Fannie? These are the most important things. There's nothing specific other than this, but depending upon the lender, and I don't want to name the lender on a call, there are lenders who can give you really hard time in the loan assumption process. So you should, before you get into a deal, you should have a clause in your agreement with your seller that you don't want to be in the, because you are assuming the loan from the seller. You are avoiding seller's prepayment penalty. Seller is getting away from that prepayment penalty. So you have to, and I'm telling you again, you have to put that clause in your agreement with seller that you walk away if the lender doesn't approve the loan. So if you have any hard money on the property, that money comes back to you if the lender gives you hard time, or lender doesn't approve you for whatever reason. Typically lenders will approve you, but there are instances where lenders may not approve you, or maybe taking a long time. So if the lender is taking a long time in approval process, you as a buyer should not be penalized as long as you are doing what needs to be done. So, Yanev is asking, agency loans need to be 1 million plus. Is that true? So it may be true, Yanev. I'm not 100% sure because we are not in the smaller deals. But you can ask somebody, any of these brokers, they can tell you. I know SBL loans, Freddie SBL and stuff like that, they are on the lower side. But I think Freddie SBL should be available. You should be able to take advantage of Freddie SBL. And that should not be more than there. We should not have $1 million restriction. And I'm not 100% sure. I know I have taken Freddie SBLs for 1.5 million. And I think that's the purpose of Freddie SBL or any SBL, is to give you the loan, which are sub million, hopefully.
Yeah, Prashant, if I jump in there, yeah, for Fannie Mae small balance loan, you can go up to $6 million. But Freddie, I think you go up to $7 million in those.
Up to, right? I mean, the
Yes.
question was below 1 million. Do they give the loan for below $1 million balance? So
yeah, I'll have to check into that myself. Yeah.
Okay. So Alchin is asking how much is higher upfront fees? What is it? So average broker fees typically on these loans is 1%. However, if deal is not working out, you can go and negotiate with the broker. They may come down a little bit from a brokerage standpoint, but upfront fees for from a lending standpoint, from agency, typically 1%, agency will have, and the local banks also 1%. But for private money, it could be 2%, 3%. I mean, they can ask for any kind of fees from you. So you are paying the broker fees, you are paying the loan origination fees of the lender. You could be, and the loan origination fees is the high. That's really the variable, right? I mean, between Freddie and local banks, those are typically 1%. But if it is private money, they may ask for 2%, 3%, 5%, who knows what. So it could be anything. I mean, I've seen 3%, 4%. So cannot say what is the high. High could be 10% also. There are people who are giving you the money, equity. They may charge you 10% also. So private is private, right? Anybody can ask whatever. It's all supply and demand. Diego says, thank you. Yes, Diego, you are very welcome. Kemi is asking, I cannot attend Saturday underwriting class. Do you record them? Where do I find it? Yes, Kemi, Kiami, right? Kiami. Yes, we do record them. And if you send us an email, hopefully we can send you back some recording. I mean, a folder where we have those recordings. I mean, at least, no, those recordings are actually going out.
Yeah, they go out. So just please put your email in the chat and we can get that to you.
Yeah. So recording. So if you register for those webinars, whether you are able to attend them or not, you will get the recording back. So every week you register and you should start getting those recordings. One thing I must say, if you are watching a recording, you feel like you are watching a movie where you don't get most out of it, because when you are on the session, and Casey, again, register for the underwriting sessions in the middle barcode, and then you would start getting the recording. But once you attend and once you are attentive and listening, that's when it gives you the most of your time. That's just my personal preference. You mentioned it's best to use broker. Couldn't you save 1% of broker fees? Yes, you can save 1% of broker fees if you are going directly to the lender. But when you are in a deal and you have 60 days to close, right? When you have 60 days to close, you would be running around. I mean, it's a tough job. It's a tough job because lenders typically take their sweet time to respond to you. If you already have a relationship with the lender, yes, you can do that by saving that 1% broker fees. But the broker already has existing relationship with these lenders. So in my personal opinion, again, everybody is different. If I want to close the deal properly and I want the best term, I would go to a broker, because broker is going to shop for you, because you probably won't be able to shop because you are not the subject matter expert. So you may end up finding a better deal in terms of the lending. A 25 basis point difference between lender 1 and lender 2, you could save a lot more than what you would pay to the broker. So that's just my personal preference. So I see a bunch of email addresses. Paul, if you don't mind, maybe note them down, sir, for me. So yes, you did sign for the classes. Cami is saying that she signed up for the underwriting classes, but got confused with the time. No, we are doing it again, EST, 4 o'clock on Saturday. And you do get emails from us with the recording link. So if you register, you will always get the recording link back within a day or two. So after Saturday, you get the recording link back maybe within 48 hours. All right, that's all I have for today. I just want to. So Alchin, you on the screen, you have this underwriting session, basically barcode. You can just scan that and you can register. So that is basically www.cashflowchamps.com/underwrite. And we'll send you an email with the link also. So Paul, I'm hoping that you are catching that, sir, for me. All right, Bobby.
Yeah, I'm catching all these emails, but if they go ahead and sign up, like you said, they'll get it. But we'll also register them as well. So yes, I'm catching those.
All right, sounds good. Bobby, thank you so much. Appreciate your time. Casey, again, thank you so much. Alchin, appreciate you joining. And I hope we are providing value. You are learning something from it. And if there is anything that you want to learn, at least send us an email. That way, we can put that on our topic list for future. We look for, so basically, again, on the screen, you have 3 barcodes. Schedule a call with us, join our underwriting sessions. And if you want to join our inner circle, feel free to connect with us, talk to us. We would love to see, hopefully we can improve your multifamily syndication journey. Last thing is register for the webinar for next week. This is the last barcode, QR code. And that's all we have today. Appreciate your time, basically. Everybody, thank you so much for your time, and we'll see you next week. Thank you, guys.